All right, Pak Farung, Pak Daniel, we'll start the webinar right now.
Yep.
So, good morning, ladies and gentlemen. Welcome to Siloam's second quarter earnings call webinar. We hope everyone is doing well. Today's webinar will be moderated by myself, Willy Chandra, as Siloam's Investor Relations. And in today's webinar, I'm joined by Pak Farung Kana, Siloam's Managing Director of Healthcare Business and Investment, and Pak Daniel Phua, Siloam's Group CFO. This webinar will be divided into three sections. So first section is the delivery of financial and operational results by Pak Daniel Phua. Second section is the delivery of Siloam's business update and strategy by Mr. Farung Kana. And lastly, we will open the floor for Q&A. For participants who want to ask questions, please use the Q&A function in your Zoom screen and feel free to ask questions during the sections. If you wish to speak directly to the management, please use the raise your hand function and I will enable you to speak. So without further ado, I will pass the floor to Pak Daniel.
Thank you, Willy. Okay, welcome everyone to our investor call today. Very excited to be here with you and to share our results with you as well. I think we have had an exciting quarter. Willy, am I able to? So just give me 1 second while I scroll through the slides. Okay. In terms of the performances for Q2, as you can see, the Q2 revenue is sitting at 2 billion compared to 2 trillion compared to 1Q2023. So relatively flat. Which is exciting in itself because we all understand that 2Q2023 was the Lebaran month that typically would have lower performance by around about kind of 10 to 15%. So the fact that revenue maintained flat at 2 trillion and obviously EBITDA being the same, being maintained at 600 B for 1Q to 2Q does show that this is a Q-on-Q growth because Lebaran obviously does have a big factor to play in terms of performances. And I think the other thing exciting to share is that I know previously I've given the guidance that post-COVID, we're aiming for a EBITDA of 25%. You would have seen that consistently we've outperformed that, and we have recorded 4 quarters consecutively of 29% EBITDA margins. Which again give us a strong confidence that this is the kind of EBITDA margin that we'll be looking at going forward. Now, is there a possibility for this to improve further? I would say definitely yes. There are still various initiatives we are working on. I mean, both from the aspect of cost management, also in terms of managing our payer mix, managing kind of our procurement, our contracting spend, and also the continued ramping up of the ramping up hospitals will all contribute to a continuous improvement in EBITDA. But happy to report that we have been able to consistently maintain a plus 29% margins from 3Q onwards to now. So 3Q onwards, if you remember, is really the first quarter that we leave the shadows of the COVID behind. So again, the post-COVID era, we are happy to see that we really are able to post EBITDA margins that is actually surpasses what we were doing during the COVID era. So one half of the revenue we had it at 4 trillion. This is a 20% improvement compared to last year. And on a Q-on-Q basis, this is a 21% improvement compared to 2Q22. Again, similarly, you've seen that EBITDA gain is even higher than what the gain is in revenue due to the improvement in margins. One half to one half, EBITDA went up by 48%. 2Q to 2Q, it also went up by a similar magnitude. But EBITDA margin, happy to report that we're seeing now at 29.6% compared to one half 22, whereby there's still a lot of COVID, we were only doing 24%. This also translates well, obviously, into our NPAT, a net profit at 516 B for one half 23. Improvement of 142.5%. And on a Q-on-Q basis, similarly, is a 133.6% improvement. The NPAT margins basically doubled compared to what we were doing in 1H 22. So I think that is all very exciting results for us to report. Moving on. Willie, I think there's a bit of a lag on my side. Why don't you move this slide? Okay, thank you. The quarterly EBITDA, if you look at it compared to the pre-COVID era, if we were to look at 2Q19, which is really the last pre-COVID EBITDA that we had, we are sitting at 607 B versus 181 B. So this is an increase of more than 3 times, yeah, 335% in comparison to what it was in pre-COVID time. So basically, even accounted for kind of COVID fluctuations. I mean, this is a CAGR of 35% solid year-on-year growth in EBITDA. So we were very happy with the results. And you will see that that result is similarly translated into the operating cash flow as well. Operating cash flow is similarly showing a CAGR of about 30% as a result of the working capital improvement and so forth. But obviously, that translates well into NPAT. You might recall in 2Q19, we were basically at just break even for NPAT. We are now making on a quarterly basis, close to 250 B, which means that our annual net profit will be looking easily at plus 1 trillion. Yeah. So I think all very strong results to report, and management is happy with basically how the flagship has performed. And also, not in addition to that, is also the ramping up coming out of COVID have also rebounded strongly. So that this is a testament that the ramping up hospitals will not rely upon simply just the COVID traffic. In fact, they do well in the absence of COVID as well. Moving into the operational results. And the operational results basically supports, Willie, I think the presentation disappeared. Can you
Yeah, the slide.
Willie, I think better just let you guys run it. I think this co-control thing doesn't seem to work very well.
Sorry about that. We're showing the screen again.
Okay. Operational wise, I think what's interesting about result is that the financial results is basically supported by a solid operational growth in both inpatient and outpatient volumes as well. As of 2Q23, inpatient volume grew by 28.6% to 72,000 patients compared to 56,000 patients in 2Q2022. Inpatient days, I mean, similarly, is an increase of about 20%, getting us to 226,000. The company has served 910 outpatients in 2Q23. It's an increase of 27.5% compared with 714,000 outpatients served in 2Q2022. On a quarterly basis, patient admissions and the patient days both grew by 0.5% and 0.4% respectively compared with 1Q2023. And outpatients in 2Q23 were only lower by 1.6% compared with 1Q23, and despite the Lebaran season in April 2023. So I think that is significant. Yeah. Usually we would see a drop by the magnitude of 10 to 15%. Again, as most of you will recall, this Lebaran is also a Lebaran whereby most people did go away, as opposed to Lebaran previously, whereby some people decide to stay put. This is the first Lebaran whereby Indonesians were generally traveling widely, and in spite of that impact, we were still able to maintain the operationals and financial performances compared to 1Q23. I think that is a significant testament to management ability to execute. On that note, I will pass the time to Varun to talk a bit more about the operational results and highlights. Varun, over to you.
Thank you, Daniel, Willie. So first of all, congratulations, Dan. Like you said, this is the best ever quarter from an EBITDA standpoint, and who would expected that a Lebaran quarter will turn out to be the best ever quarter? So I think I must mention that we are extremely pleased with both the top line and the bottom line performance. And adding to what you've said, when we see performance on a per day, productive day basis, and that's a concept that we've been talking about in the past as well. To us, what matters is really not a quarter, because a quarter could have a Lebaran, a quarter could have February, a quarter could have December. So what we've started doing over the last, I think, 6 odd quarters is really look at the GOR, or the revenue per productive day. And I'm pleased to add to what Daniel stated, that our revenue per productive day is significantly higher than even quarter one for this year. So while the EBITDA numbers look quite the same, 603 and 607, but as we see on the organic growth that we are seeing on a per day basis, even vis-a-vis first quarter 23, I think we are very, very pleased with it. Just adds to the sustainability post-COVID, and the fact that we've been mentioning that things that we did during COVID, which is continuing to embark on our Siloam 5.0 strategy, is yielding results on a sustained basis. And I think even going forward, you'll see fantastic results. Our assessment for the next 2 quarters is that our GOR per productive day will continue to be as we see the growth. And given the fact that second half of the year has 6 to 7% more productive days, that's an incremental addition as well. I think a couple of other things that I'd like to touch upon this time, Daniel, is really start to give the concept of the new archetypes that we intend to follow. And maybe, Will, you can get to the slide, yeah. Now, this is really a transition slide that I wanted to show today. This is not where the transition is not happening today, but I think we need to give the market a sense of how we are thinking to develop our strategy beyond the Siloam 5.0. Not sure what we'll call it, but I think we are now looking at what the next 5 years should look like, how we can continue to grow our revenue ahead of the market and sustain our profitability, or rather build on it. So one of the key things that we're doing, historically, we've looked at our hospitals as flagship, mature, distinct, BPJS, and ramping up. Now, these were categories created because we had a lot of new hospitals in 2019. And I remember when we said that, the ramping up business was not profitable. And today we are at a stage where almost every single hospital of ours is profitable on an individual basis. And of course, on a blended basis are very good. So it's now time to move to a different way of not only looking at our results, but also operating our hospitals. And we've done some work with consultants over the last 12 to 18 months to try and identify how our service delivery models should be. How should we look at range of specialties? How should we look at pricing across the network? Because every hospital in our network is different from each other. How should we look at our facilities? How should we look at the experience that we are delivering? What should our cost management structures be? What should the revenue contribution be? And how do we lead the market through this strategy? So the 3 basic categories that we've created is premium, value seeker, and BPJS. And we've also kind of started to categorize our hospitals within these 3. So 10 of our hospitals get categorized as premium. 13 hospitals get categorized as value seeker. And 18 hospitals get categorized as BPJS. And our endeavor will be to differentiate on service, differentiate on pricing, differentiate on centers of excellence, and differentiate on cost management in each of these categories. As we go forward, we will try and give you a sense of our results starting next year, broken into these 3 categories. So you'll be able to see premium hospitals, what's the kind of top line that we do. You'll be able to see value seekers and BPJS play, what's the kind of top line that we do. And we'll also give you a sense of our operating models and the efficiency that we're able to produce by virtue of those operating models. So I think that's a precursor to what's coming in our next phase of strategy I wanted to share with you. Going forward, I think let me also talk about the quarterly results. Our mix, we've had a very favorable payer mix. Will, if you can go to the next slide, please. We've been retaining our payer mix. I think the reason our business has sustained such level of growth and such level of profitability is that we focused on the premium market as well. Our share of the market, as we told you last time, is 17 to 20% in the premium segment. We continue to go deeper. We continue to get stronger by creating clinical centers of excellence across our network. From a payer standpoint, we're around the same. 17% of our business comes from BPJS, and the balance 83% actually comes from the private segment, which is out of pocket, corporate, and insurance. So this is sustained, and I think this is the right level, as we've always maintained. Anything less than 20% is a very healthy level for us to operate as a blended network. On the clinical program side, we've actually added a new slide to show you what's happening on each craft group from a growth standpoint. And on the left side, you see is the volume growth. So we told you 2 quarters back that maternity is a segment that we want to focus on because we don't have the highest share of the market, and we'd like to get there. You'd see that we've had a fantastic growth on maternity volumes, 30% growth on a maternity volume. We've added Nest as a program to maternity. And not only have we seen incremental volume growth, you'll see that the ARPD, which is the average revenue per day, is also growing the highest in maternity. So what a combination to have. The business that is growing max on volume is also growing max on productivity, I think is the right thing to happen. On maternity volumes, we've seen a lot of people coming to us on account of Nest. And when you see maternity volumes going up on OP, you should expect that this will also convert into IP 9 months later. So that's how the cycle works. And on average revenue per day, again, bringing the Nest program in has added a lot of value to our program. Needless to say, the ARPD is growing across all specialties in excess of 10%, in the range of 10 to 40%. Willie, can you go on, please? We continue to focus on 8 core focus areas, which is cardio, maternity, pediatrics, orthopedics, neurology, digestive, uro and nephro, and oncology. We've told you last time that oncology is doing extremely well. Oncology services are getting extended well beyond MRCCC. We are now developing 5 oncology centers across Indonesia, and we expect the same level of productivity, same level of profitability, and same level of clinical care on oncology being available across Indonesia. There are 4 centers of excellence, rather 5, that we are focusing on for this year, which is maternity, pediatrics, orthopedics, digestive, and oncology. And we will continue to see high growth in terms of volume and revenue per productive day on all of these core specialties. Go on. We've always spoken about our expansion strategy as well, because these questions keep coming. We continue to believe that 1 to 2 hospitals per year is the optimal level of expansion that we should look at from a geographic standpoint. And we've been adding clinical programs, needless. We are adding clinical programs to Makassar, to Lippo Village, to Kebonjeruk, and this will. We've just started a new cath lab in Lippo Village. Makassar will see oncology expansion. It's a new building which is coming in, and we'll have a center of excellence on oncology. And we are adding radiotherapy to Siloam Hospitals, Lippo Village. I must tell you, this is the first LINAC that will come into Tangerang. Go on. In line with what we spoke about a couple of quarters back, our expansion, the 1 to 2 hospitals that we want to add from a geographic standpoint also, need to happen in markets where the premium segment plays fairly high, because this will allow us 3 things. 1, allow us to grow fast, so that we don't have to spend 5 to 7 years, which is what we've taken in the past, to really turn profitable from a hospital standpoint. So if we operate in Surabaya, Jakarta, Bali, these markets in our assessment will turn profitable for a new hospital in less than 2 years, and get to path of profitability, which is almost equal to the blended numbers that you see in 3 to 4 years. So we should be able to deliver 30% EBITDA on hospital level in 4 years' time if we open hospitals in these premium markets. So Surabaya, Manyar, and Surabaya, we only have 1 hospital, as you know, and competition has spread its wings far stronger than us in Surabaya. So we're kind of catching up a little bit. But we also know that we have a dominant position in most of the centers of excellence that we operate in Surabaya, including cardiology. So the state-of-art infrastructure that we are adding in Surabaya, actually we're adding 2 hospitals, one in Manyar, will be like nothing that the city has, both from a technology and infrastructure standpoint. So we are quite kicked about opening this hospital soon. The next one that I want to talk about is Kemang. As we reported to you, we are now wanting to expand further in Jakarta. And Kemang is a territory that we've not operated. We've seen competition come in there as well. So another state-of-art hospital will come in Kemang Antasari, another couple of 100 beds, and this will be 4 centers of excellence that we will try and bring in here. Needless to say, from a talent, technology, and infrastructure standpoint, this will be as good as it gets anywhere in the world. Yeah, go on. So let me talk about something that I think is helping us grow significantly faster. That's the digital transformation that we've done. Our patient voice is completely digitized, and you'll be amazed at the fact that 75% of our patients leave us with a feedback. And needless to say, given the fact that our NPS scores are in excess of 90, means that most of our patients are actually joyed by the experience they see at Siloam. Almost 20% of our first half OPD numbers are digital acquisitions. So about 308,000 people booked an appointment digitally in the first half of the year. And this continues to grow. By the way, as of last reported numbers, if you see on a monthly basis, 27% of our customers are getting acquired digitally. We are also adding services. In the Q2, we launched digital radiology and lab. It was a soft launch, though. We shall be going commercial in the Q3. So we will now acquire lab customers and radiology customers online as well, which would mean that we will be able to go beyond the captive customers for lab and radiology. And that opens us to well beyond the 4 million patients that we serve every year. So now you could actually book your lab and radiology services online, even if you don't visit Siloam as a patient. So there's a huge market that was not catered to earlier. Now from a lab standpoint, we'll start catering to that market as well. Another interesting piece is, almost 2 million downloads have happened for the app. So our app is now becoming a very integral part of the Indonesian healthcare system. These apps are being used by people because we are also seeing significant traction on our website. I'm happy to share that a number that was just about 200,000 hits to our website 2 years back. Last month, we got 15 million hits to our website, and we're constantly growing on a quarter-on-quarter basis. Our best number, I think, in Q1 was 6.7 million in a month, and last month we reported 15 million odd hits onto our website. And it is not only for commerce. Actually, people are coming to the Siloam website for information as well. It has a wealth of articles which we brought in there, which help people understand common health problems on a day-to-day basis as well. So it's becoming the go-to site for Indonesians in many ways. Go on, Willie. Our backend IT infrastructure, 97% EMR adoption. This is as good as it gets anywhere again. I don't know of too many hospitals that have a 97% EMR adoption, to be honest. 78% is e-prescription adoption, and 85% is radiology EMR adoption. So the more digital we get, the more transparent we are, the more satisfaction levels we get, and the further we can integrate our services to any other platform or provider globally. This will allow us to enhance our clinical care services because the world is moving towards AI-enabled services and so on and so forth. Once you have a backend infrastructure as strong as what Siloam has, that allows us to grow our services significantly as time goes by. Go on, Willie.
Okay, that is all, Pak Harun. Thank you for
all right. Thank you once again, Willie, for helping us with this this morning.
Sure.
And I'm assuming you'll go to the questions now.
Yes, thank you very much for the update, Pak Farun and Pak Daniel. Before I open up the Q&A floor, I would like to remind for all participants who wants to ask question, please use the Q&A function in your Zoom screen. And if you wish to speak directly to the management, please use the raise your hand function, and I will enable you to speak. We have two raised questions over here, so I will allow Ari Jasja from Macquarie to talk. Hey, Ari.
Hi, Siloam team. Can you hear me okay?
Yes, all good.
Okay, great. Thanks, Pa Daniel, Pa Farun, and Willie for the updates, and well done for a strong result. So I do have a few questions here. And the first one is in regards to revenue intensity. So good to see the rising volumes on the complex craft groups. Can you put on the possible ramp up of the revenue intensity in the next couple of quarters? I'll start here. Thanks.
So Dan, let me take that. Willie, are you bringing up a slide? So, Ari, a couple of things from a revenue intensity standpoint. So one, we mentioned to you that this is first year where we've taken price increase across our network on one day, on one particular day. Previously, it used to be scattered through the year. So this time, we took the price increase in January, applicable on 1st February across the board. And therefore, that impact has already come in to the first 2 quarters that we've seen. Another piece that impacted which gave us revenue upside, apart from volume, was the BPJS price increase this year. As you're aware, the BPJS also took a price increase this year. Going forward, our complexity continues to get stronger. So there are 2 things that we're working on this year. One is oncology services, and we are trying to expand that as much as possible. Our linear accelerators, a new set of linear accelerators will start coming in. And as you know, that is OPD revenue. So that will also impact our ARPOB quite significantly and favorably, because the patients do linear accelerator or use linear accelerators in the OP, and that gives us a favorable impact. Another piece that we've seen and we're working on is reducing the ALOS this year. Our average length of stay is also getting better, slightly better. That again will have an upside on our ARPOB. So clinical complexity continues to be the key driver of our revenue intensity, apart from price increase and BPJ's impacts that we've spoken about.
Got it. Good to hear that, Varun. And then related to that, right? Do you sense any divergence between the inpatient spending improvement as compared to the outpatient visits? And I also wonder if there's any down trading trend away from private to BPJS, for example. Although for Siloam BPJS contribution seems to be quite stable on a Q-on-Q basis.
Yeah, so on a revenue basis, there isn't much movement that we've seen. On a week-on-week basis, things can be different. But when we blend the number, I think the 83-17 has prevailed. And really, we've said that in the past as well. So, you know, as the smaller hospitals, which is outside of Jakarta, because we've had a struggle with those hospitals in the past. So when those hospitals start to do better, BPJ's contribution will go up. But the fact of the matter is that BPJ's going up doesn't mean that it will be non-profitable, because we're also parallelly working on getting a model right for those hospitals, and which is where we shared the archetypes this morning with you. Now, with the BPJ's hospitals growing as well, I don't think we will be impacted adversely on margins, because we're really working on perfecting that model too. But having said that, so far, no shift or meaningful shift has happened in our payer mix. And anything under 20 on reported numbers, I think is a very, very healthy mix.
Got it. Thanks for the color, Varun. And then my next one is on the margins. So certainly we see a really solid margins in the past 4 quarters in the 29 to 30% range. So just wondering, how do you see room for further upside from there? And I wonder if the new method for classifying the hospitals may ultimately impact the aggregate margins as well on the back of the new strategy. Thanks.
Let me take that one, Varun. I think you touched on an interesting point there, Ari. I think the new way of clearly looking at a different archetype, we do believe that it will improve margin going forward as well, because it means that each of the hospital type can be more specialized, I guess, to take advantage of their particular demographic, be it BPJS, value seekers, or premium. Yeah. When you kind of have a hospital with a little bit of a mixed identity, optimizing margin is always difficult. Yeah. I mean, trying to serve, if you like, business class and economy class effectively on the same seat, is going to result in costs that is not the most efficient. So I think on that basis, we certainly see that will drive improvement in our productivities and hence in our margins. Now, if you would ask me, look, at this stage, I guess, I wouldn't want to give out any new guidance at this stage. I mean, obviously, the EBITDA margin improvement, if you look at over the past 2 years, it has been very significant. The only thing that I would say is that we do believe that there's still significant room to improve on it. Compared to our peers, we do still see a gap. And it's something that internally that management is actively discussing about. We are still working through a few strategic cost reductions projects that is going to take a bit of time to realize. So basically, we've done a lot of the low hanging fruit, optimizing contract costs, look at utilities, cleaning costs, security costs. We're now looking at things like how do we optimize the layout of the floor space? How do we then optimize the nurse to bed ratios and the use of nursing pools and the use of technical staff that can do some of the nursing duties? How do we look at optimizing the P&L of each equipment and therefore ensuring that the contract services are in line with the usage and so forth? So those we believe that over time would also use efficiency improvement, not to mention the fact that we are starting projects on revenue leakage. We are still continuing on our project with the material cost reductions, which is still running its course. And obviously on Varun's side, the payer mix, we do believe that will continue to trend towards the stronger private corporate segments. As you can see, we now have a clear strategy to focus more on the premium, to increase on the complexities, as Varun has alluded to. You also see that even with our new hospital opening, the locations, we are targeting definitely a more premium class demographic. So as we move up in terms of our segmentations, and also as we have a clearer segmentation strategy with regard to our hospitals and differentiations, yes, we do believe there is still significant room to be able to improve the margin.
Got it. Thanks, Pak Daniel, for the color. And then my last question is on the new hospitals. When can we anticipate the launches after the recent land plot purchases in Jakarta, then Surabaya? Thank you.
Maybe let me take that one. You know that there's a few hospitals that is in the works as well, in addition to what Varun has mentioned. We are working on as you know, Surabaya is a Chito hospitals. The Chito hospitals at this stage, we do expect that to open next year. And we are also at this stage working on the extension of the Surabaya hospitals. I mean, building a new hospitals next to the existing Surabaya hospitals. I think we expect that to come in operational towards the end of the year. The projects that Varun mentioned just then, the Surabaya Manya and Kemang, the constructions will start towards the end of this year, early next year. So we believe there will be probably about 18 to 24 months before when those hospital operationals. Maybe to add one more is that we also recently just settled the purchase of a rental of a piece of land in Bandung. So we will also be building a new hospital in Bandung as well. Again, all that, as you can see, quite clearly link into our strategy of targeting demographics that will be more concentrated and focusing on segments that really have a premium side to it.
Understood. Appreciate the color there, Pak Daniel and Pak Varun. All the best for Siloam.
Thank you, Ari.
Thank you, Ari.
On the next one, Pak, we have Ingrid here from Mandiri Sekuritas who raised her hand. I will allow her to talk.
Thank you. Hi, Pak Farun. Hi, Pak Daniel. Hi, Billy. Thank you for taking my questions and congratulations for the very great result. Just want to ask you questions. The first one regarding the volume. So can you comment more on the reason behind the strong outpatient and inpatient volume, despite the Lebaran? That's my first question. And regarding the margin, so you consistently beat that, and just want to know, until we see more more cost efficiency done, can we just extrapolate what you've booked in the past 4 quarters to be your sustainable margin in the next few quarters ahead or next few years? And then my last question is more regarding on the new health law. So what's your take on that, and what's your strategy to benefit from this law? Thank you.
So Daniel, I'll take the volume and the health law, maybe leave the margins back with you. Ingrid, organic volume growth is going to be happening for our business, and that's driven largely by our strategy. And let me give you a quick glimpse of that again. From a core business standpoint, I think our partnerships are taking us to a different level. I mentioned this to you that in the core business, we focus on 3 things. One is developing our partnerships. So we've gone to 3,100 accounts now, and these are active accounts. These accounts give us business every month, right? Second, there's so much work that we are trying to do in terms of our craft groups, and wherever we are weak, we try and develop focus on that. Wherever we are strong, we continue to get stronger. Wherever we are weak, as you've seen in our maternity case, our maternity volume growth is 40%, right? And quarter on quarter, 40% is not easy to get to. But I think that's the focus that we have. Wherever we're not able to get a fair share of the market, we will go very deep. We will get into clinical appointment. We'll try and get focused commitment from each of our hospital directors to kind of drive that craft group. And the third is tech and technology. Tech, which is medical tech. I think we're very, very clearly focused. We've always shared our medical capex numbers. They continue to be strong. We spend on medical technology quite significantly so that we stay well ahead of the curve. And that also drives significant volume growth. If your medical tech is better than the others, I think there's no reason to believe their volume growth will not happen. On the tech side of it, and we shared on a slide, our digital capabilities are currently so strong. And I can tell you, I don't know if you've ever compared our digital capabilities to any other developed hospital chain in the world, you'll find they're as good, right? And that is driving a lot of volume. If 15 million people start hitting your website every month, even with a very reasonable conversion rate, we will see a lot of patients coming to us. So partnership, focus on craft groups, investment in medical technology, and investment in patient channels is what is yielding volume growth for us. And I'm going to again emphasize this is sustained growth. Will continue to happen quarter on trailing quarter, quarter on quarter. So get used to it. I know you ask these questions every time as to what is getting the volume growth. These are the initiatives that we have, which will drive the volume growth. I think on the margin front, while my headline is the margins are sustainable, absolutely sustainable, but I'll leave Daniel to answer that question for you.
Yeah, all right. Ingrid, very good questions. I'm not going to give you a magical number. I'm going to make you guys work a little bit. At this stage, I'm not giving a revised guidance. As you can see, we have performed 29% margin consistently. So how should we look at the margin going forward? Maybe let me point to a few things in terms of levers here. The first levers is that the second half of the year, typically revenue are better than the first half of the year. This is just based on the past experiences. As revenue increases, obviously that the fixed cost absorptions improves and margins improve as a result. So I think lever one is obviously the potential improvement in revenue going forward. And lever two I think as Varun mentioned that there's various digital channels we are using to grow our customer acquisitions and to grow our volume as well, and also to grow intensity of revenue. Now, the digital acquisitions along with the higher intensity of the revenue do help margins as well. The higher intensity services generally enjoys higher margin compared to the lower intensity services or lower acuity services. So I think that's levers number 2. Lever number 3, I think as I've mentioned a few times, that internally as management, we still believe that there are a lot of room there to improve the productivities and efficiencies of our practices, be it automations or services. I mean, you will see that, for example, if you go to Siloam Hospitals, the way we have used the app now, the way we have changed the queuing systems, I mean, those not just reduce the waiting time for our patients, but they really also improve the productivity. The use of EMR allows us to start reducing the use of runners in the hospitals. I mean, these all have kind of productivity gain, and to us that is a key word, productivity. But how do we make our assets sweat more? And internally, it's an active topic that management discuss monthly, quarterly. So to me, those are the 3 levers. We certainly, if you ask me vision-wise, we certainly want to be able to get to the best in class in regard to the EBITDA margins compared to our peers. So maybe that is an aspirational target you can use as a kind of a target we have set for ourselves.
Thanks, Ryan. The last part of your question, Ingrid, is again a very favorable one. We've been talking about the regulation getting better and more favorable for healthcare for a while. And I think our optimism has come true with the government signing up for the law. I know there have been some protests and all of that, but the government's will actually is finally prevailed. So 3 key indices there. 1, the healthcare expenditure is only getting better. So needless to say, all providers, the entire health system will benefit as the spend goes up. So understand that's going to grow from 6.5 to 10%. That's phenomenal for a country which has a huge need for healthcare. That amount of money flowing in will convert that need into demand. And we should be obvious beneficiaries of the demand going up. The second part is really the government agreeing to give a biannual revision for BPJS. That's been a long-standing pain for us. I think this time we got the price increase after 7-8 years, and it's a very humble one. But if we start to get inflation adjustments every couple of years, I think it's a very, very good business to do. I mentioned this in the past. Universal healthcare in Indonesia, the penetration is amazing, right? Almost 95-97% of people have that affordability driven by BPJS, and if the BPJS yields can be fair, I think it's a great business to do. And with the level of infrastructure that we have across Indonesia, we'll again be obvious beneficiaries as that goes up. And the last part is easing access for graduated Indonesian medical students. So we've started to see favorability there as well. Indonesians can come back who are practicing elsewhere. And Bali in the special economic zone should see foreign doctors coming in as well. And I think there's a belief that talent will add to the capability that already exists in Indonesia. That too will be very, very favorable. So I think broadly, we see this in very, very good light. I hope this answers your questions, Ingrid. If there's any follow-up, happy to take.
Yeah, Farhan, just want to build up on that. Basically, in the new health law, I think there's mention about hospital-based education and basically that for the longer run to solve the supply issue on specialists. So do you have any aspiration to be one of the teaching hospitals and provide, have to increase the supply for specialists for the nation?
So the principal investor family does run nursing and hospitals or teaching institutions, but I think we as Siloam, Daniel, correct me if there's any other way you see it. As Siloam, we don't see getting into medical education is the way I see this currently. But again, premature, and therefore, if there's any additional comment to this, we'll come back to you over the quarters. Daniel.
We partner with UPH. I guess that's the way of looking at it. But ASUS, for example, is used as a teaching hospitals in collaborations with UPH for their program as well. And I think if you look at UPH, every year has been gradually increasing the number of specialized program that they're able to introduce. So we certainly see that the change in the omnibus law will allow more of those specialty programs to be introduced. And obviously, because UPH is also a group company, there is a close synergies between them and Siloam. So there's no need for Siloam to replicate that, but certainly Siloam will continue to collaborate. And as a result, we can also have access, I guess, to those specialists that come out of the training.
Okay, thank you. And my last question, can you break down more on the private side? You mentioned about 83% of your revenue coming from private. How much is the out-of-patient and how much is insurance?
So about corporate and insurance put together is close to 46-47% of the overall business.
Okay. Okay, great. Thank you so much. Best of luck for the rest of the year.
Thank you.
Thanks, Ingrid.
We still have a couple minutes to answer the last question, Pak. We have an audience raising hand. Jason Wang, I will allow you to talk. Hi, Jason.
Hey, hello. Can you hear me? Management, can you hear me?
Yep.
Hi, Jason. Can
Yeah. Hi. Yeah. Thank you very much for this call. I got two major questions. The first one is, I saw you have increasing amount of investing cash outflow. So I'm guessing this is probably linked to the deals with the group Lippo Karawaci, and probably also relevant to the first risk, because seems to be time to time we see the news of sort of buy the land from the Lippo Karawaci, and also have the plan to buy the hospital assets you list from the first risk. So I want to confirm, say, for the first half of this year, for these two parts, total you have already spent how much money, and for this year, what is your budget for this two major transaction? Thank you.
Yeah, okay. Let me take that one then. Well, as you can see from the financial statements, I mean, after one half of 23, I mean, we have spent 800 B on investings. And I think I have previously given to the market in terms of the guidance. But internally, we plan to spend about 700 B on kind of what we call, if you like, maintenance capex. Yeah, I mean, they are not just maintenance capex, but include new equipment for existing hospitals and so forth. And we have another 700 B that we're putting aside for what we call strategic capex, which is basically new hospitals, as Fadlu mentions, things like Kemang, things like Bandung, things like Surabaya, and obviously expansion of existing hospitals as well. For example, Fadlu spoke about just then, Makassar, Sentosa, and so forth. I think what is key to recognize in here is that two things. We basically pick locations to expand based on the hospital strategy in terms of how it looks at archetype. As Varun mentioned, I mean, a clear focus we want to move on is to double down on premium, is to basically develop and expand on our premium market. And basically that illustrates the kind of areas where we are buying land to build hospitals. Kemang, I mean, Surabaya, Bandung, yeah. So primarily, the decisions is made on the demographics. So we do a very extensive studies in terms of the demographic of the area. We look at the assessment of the supply of doctors available. We look at what competitors are doing, and then we basically try to find the right services to fit the need of that particular market and demographic. I mean, there are locations where we have evaluated and we feel that, look, the business case is not strong, and we have dropped it. Yeah. So I think that is this very important point. Yeah, locations are selected based on the benefits of being able to operate as a hospital. Now we have bought back hospitals from First Read, as you noted, in 2021. We bought back Surabaya. Now, why do we buy back Surabaya? It's quite simple. When we did the calculations, buying back Surabaya actually allows us to improve on our impact. And MPV also improved as a result. The value of the purchase of the Surabaya properties was roughly again is comparable to the MPV of the leases we're paying, and was also based on the valuations that have been performed. So from our perspective, considering Surabaya is a key hospital, it's strategic. We do believe that it makes sense for us to take back ownership of the hospitals. Now, if you look at other hospital group operators in Indonesia, by and large, they own the vast majority of the hospitals. We are probably an anomaly in that sense, in that we don't. So that insofar as if the purchase of the hospitals makes strong business case, improve its earning accretive, I think most importantly that it is earning accretive. It is something that we would do, but obviously we would balance that up against will we acquire, for example, brownfield hospitals? Of course. I mean, when we look at acquiring other hospitals group, of course, but everything will be evaluated, I think, on a MPV earning accretive basis.
Yeah, I got you. I fully agree with the rationale for this acquisition, but probably I just want to ask him for more on detail of, the amount of the acquisition. So you have you just mentioned for the first half of this year, a total expansion capex around 700 billion. Do you have how much is from this relevant to the acquisition for this from this first phase, and how much is relevant to the land purchase from the Lippo Group? Yeah, do you have roughly have some number here?
We can certainly send that to you, because every time we do that, the result is published. So it is available. So but why don't we try to do a summary for you and send it to you separately?
Sure. Okay, and probably another question is relevant to maybe our financial policy. So our financial has been very healthy, almost can remain less cash. I want to confirm do you have any very strict financial policy say we have to maintain less cash position, or we can actually sort of increase the debt? Yeah, do we have any a very strict policy here?
Well, there's a few limitations. Obviously, as a subsidiary of Lippo Karawaci, as you're aware, do issues bonds, and there are bond covenants that, as a subsidiaries, we do have to follow. So insofar as that, we do make sure that we monitor that, and we do not, break the covenant policy that is at the group level. But beyond that, I think we evaluate each investment decision on its own merit, including how it will be financed. But all acquisitions so far, as you can see, the vast majority are all financed through internal cash. I mean, we haven't been using any debt for acquisitions at all. Now, does that mean that wouldn't change? I would say not necessarily. We have been in the consolidation phase for the last 3 to 4 years, which means that the hospital expansions has been scaled down. I think we are at a stage whereby, we can be a bit more aggressive again in hospital expansions, because we have built the back end and the financial disciplines and the governance processes necessary to see a more aggressive expansion phase. Now, if we do that, could we then start to take on more debt? Potentially. Without obviously, breaking any debt covenant issues, but it will all be, again, I'll go back to the same term that I used before. If it creates value, it's something that we would do.
Got you. But for this financial lease, those lease from the first phase, so they are counted as the financial lease in our liability. For this part, are they counted as interest-bearing debt or not? I just want to confirm this point.
Sorry, I'm not sure I understand the question. So you're talking about
so we lease some hospital from the first phase, right? And we have this kind of financial lease in our liability. We have this item, right? Yeah. But this financial lease will be counted as interest-bearing debt for us to calculate our leverage, this kind of thing. Is yes or no? I just want to confirm this point.
Well, it all depends, yeah. It depends on what the bank is doing the calculations because the definition could change or it depends, right? So accounting wise, definitely is classified as a debt. I mean, there's no doubt about it. The financial lease is classified as a liability in our balance sheet according to accounting standards. Now, in terms of the bank calculations as to whether it's counted as a debt bearing, as an interest bearing loan, in a lot of cases, I would say no. But again, it could be different from banks to banks. But in majority of cases, they do not count that as interest-bearing loan because theoretically they are not. Yeah.
Yes. Okay. And the last question is also probably sort of linked to our financial policy. So we saw very healthy, like free cash flow, but it seems like in recent years we not yet paid too. Oh, sorry. Or we has been paying dividend, right? I just want to confirm this point.
Yes, we have been paying dividend consistently.
So yeah, so is there? So where is how is the dividend policy here, and maybe going forward?
I think if you look at the payout ratio, we maintain it at around 36%. I mean, for the last 2 years consecutively. I think that is a healthy payout ratios. Could we vary it a little bit up and down depending on the internal needs here, of course.
Okay.
But
Okay.
we don't have a fixed policy per se.
Okay. Got you. Very clear. Okay, that's all my question. Thank you very much.
Thank you, Jason.
Thank you very much, Jason. I think that concludes our call for today. Thank you very much, Pak Daniel and Pak Farun, for sharing Siloam's achievement. And thank you for all participants who joined the call. If you have any questions, please reach out to me anytime through my email or WhatsApp. And thank you and have a good day, everyone. And we'll see you on the next webinar. Take care all.
Thank you, Willie. Thank you, everyone. Bye-bye.